Alright guys, welcome back to another Forms Digital video. So as you can see, this is Euro USD pair that we are looking at. So this is the updated from last week video that we had talked about. So if you haven't watched the last previous video on Euro USD, then go and look at that video. Was about the manipulation phase of what happened over here up top over here and how this became to come down and how we had a liquidity void right here where we were expecting for this to get filled. So today's video is going to be a little add-on to that from last video. So if you haven't watched that, then make sure you go watch that video. So we all had expected for, price to get taken out. Of course, the origin of our move started with this order block setup right here, where price took a low out of this, and once it came down to the point it retraced. And I always tell people, after a low is get taken out, you can either expect two things: either a retracement to go into the same direction, or either a reversal. In this case, we had a retracement to go. We had a reversal. So obviously, it was contracting real hard. It wasn't showing no signs that price wanted to go down to fill this void. And one of our key signs here, where if you look closely, we had this candle right here where price came down right here and came up and closed here, and then you had the second one did the same thing. So there's a change of character of the price. Usually when you see something like this, you know this is definitely a reversal point, especially after a low got taken out, when it took out this liquidity that was below here. So we know price was going to take out our the high above here. So once the high above here has got taken out, then we had our expected for price to definitely come down to fill this void. So for those who don't know what this is a liquidity void setup. And what liquidity is when there is a range, when it's a range in price, and all of a sudden we see explosive price coming out of that range. And that was happening here. We was waiting for this price to get filled. So once this got filled, right, what happened? As you see again, we got the same candle that happened. What? It filled, and then right on this candle, price came down and closed here. That is a sign of a reversal. And obviously the rest is what? History. Y'all know, okay, hey, now we in up momentum. Based on the next order flow, we know what? There's a void right here that happened. If we look right here, there was a void right here that had to get filled. We had liquidity, and then we had a void right here that had to get filled. So what happened? Price came into this area and what? So and tapped right into this area of the last up candle. So how I teach liquidity void, once it always the last up candle that before price came down to where you expect price to get filled at. You can either do it at the wick or at the volume. It depends on your own what you feel like is based off of your own experience in trading. So price came into this area. Tap into this area, right? It didn't tap into the volume, but it tapped more into the wick instead. That's why I say it just all depends on how you expect it all depends on your experience in trading. So price came and filled the void, right? And then what happened? Price came down, and then what do we have another here? We have another range where what? Price filled this void and what? Came straight on down. So you have potentially, like, you could have bought here, and you could have, as price was going up, as it was mitigating off of each low, because whenever there's an uptrend, right, prices are going to always mitigate off the previous downtrend that it broke out of. So like, for example, like right here, if we look right here, this is the last down candle before price came up. If you see price came here, this is the last down candle before price came up. And what happened? Price later on came back, following up by this candle right here. And then what? Price came up. This is the last down candle. You look to the left, right here. Price came here. So that's an example of mitigation. Let me mark that for y'all. So there's two ways of mitigation. You have shifted market structure of mitigation, and then you have mitigation off of when you're in a trend or uptrend or downtrend, and that just every previous high is getting broken out, because every down momentum you see before, every little swing you see before the price goes up is a high. So what happened? It breaks out of that and it goes here. So let me mark that for y'all so y'all can see what I'm talking about if y'all don't see that. Put a candle here. So you have, when price was going, what happened? We have this up candle, this down candle right here. And what happened? Price came back to that candle on this candle right here. And you had the next candle. This is a down candle right here. And what happened? Price came down, came up, came touched by this candle right here. So this is what you call mitigation. And then what happened? Price came down on this last down candle when price broke out. What? Price came back to here. So when I say mitigation, this is exactly what I'm talking about. So you see how the last down candle the price came to? This was the last down candle that price came to as it was going into the uptrend, and then what? Later on, what? This candle right here came to it. When this candle right here this down candle got broken out, what happened? Later on, price came down by this level. When this down candle right here got taken out, what happened? Price came down to this level. So that's what I mean by mitigating. So there's two ways how you can look at that. So that's what you call mitigating off of each level that's to continue to go up in this momentum. And so you had as it was going up, you could have been buying each of these levels. What some people call it buying a dip. But we call it mitigating off of each level. As it mitigate off of each level that you broke out of, that's 1, 2, 3. Now you don't want to constantly keep buying dip. Once it get to a certain height, I'll probably say this part. If you was gonna buy right here, this is probably your last buy entry going up, because you don't want to start buying way on top of here. Now that's kind of getting risky, because now you're kind of chasing price. So I'll probably say once around this range, with the momentum of the move has started, then yes, these could be your 3 entries. And then guess what? Your exit would be where? Your exit would be right when to fill on the next order flow to fill this liquidity void, because we know, okay, hey, this is a void that has to get filled. So we know once this void get tapped in, we can expect some down momentum going out. And then what happened? The same thing happened. Price tapped in and came down. It started contracting first in this little range, and then what happened? We had another liquidity void. So if we look right here, we had the same thing right here. We had this liquidity void where price just shot down hard right here. And then what happened? Price came down to the last up candle where price took it out and came down. So you could have, guess what? Sold it here. So all this goes back to understanding order flow. Like, I try to keep it as simple as possible. The only way how you're going to understand order flow is you have to understand the different cells that we trade. So we only trade order blocks, turtle soup patterns, rejection blocks, and mitigation. And I think that's it. Mitigation, rejection blocks, order block. Oh yeah, liquidity void. So then all 5 steps that we trade. So that's what we call low liquidity run. If you don't see that, then guess what? It's considered high liquidity. High liquidity is when price is like this right here, for example. This is considered high liquidity. Why? Because this little contraction point, this is considered high liquidity. Why? Because there's no gaps. Everything's balanced by the wicks. There's no gaps between the body. The wicks is filling the body of the candles. There's nothing besides the high that has to be taken out. So other than that, this is considered high liquidity. So it's going to be easier for it to drop back down. And this is low liquidity. Before this happened, before this void got filled, that was low liquidity. So it was easier for price to tap. Once it filled this area, it was easier for price tap right back into this, fill this, and then go back down from here. So it's not gonna really be a long video, because I had already did a previous video on this. This is just an update on what price did from last week. But the week before, I had did a video on this whole thing. So if you haven't watched that video, watch that so you can understand what I was talking about with the manipulation part. And then here's an update. So the video is kind of just more about the setup of why this tap into here what we expected once price came and filled this void, and why it did it. So now you understand what a liquidity void is. So other than that, if you feel you have value from this video, make sure you subscribe, like this channel, hit the notification bell so you can be able to get all notifications when we post. Also, join the Discord group below. We do live sessions every Friday and Saturday, as well as we do live trades every now and then. So make sure you join the Discord group. It's free. It's for serious traders who are, whether you're new or not new, where you're trying to get better or you're trying to learn it. We do our teachings based off of ICT teaching. So other than that, hope you have a great trading week going into Monday. See you until next video.